Hi guys. Hello, hello, good morning. Hi guys.
Morning. Can you hear me?
Yes, we can hear you.
Okay.
Hello, good
Hi,
morning. Right.
everyone. Hi, Papa. Hi, Martin.
Dapper, your voice is a bit low though.
I think it's muted.
Daps, can you hear us?
Okay, okay. I think I was muted. Can you hear me now?
Yeah, we can hear
Yeah.
you.
Yeah.
Hi, how's
Hi,
everybody doing?
how's everyone?
I'm fine,
Fine,
thank
thank
you.
you.
Sorry for dragging you out today. Today is public holiday. You guys should be resting. Um, yeah, I think there's no better time to have this conversation. So we're just gonna dive right into it. For those of us joining us from LinkedIn that don't
Sorry.
already know, can you hear me, Tola?
Yes,
Yeah.
but I think there's an echo.
Okay, give me a second. Let me check that out.
Yeah, I can hear you, but it's a bit of lag.
I'm going to
was
drop.
low.
Hmm?
I'm going to drop off and join back on. Let me see if that's the problem.
Okay.
That, I think your voice is low as well.
How is it now?
I think it's low. I'm not even sure
How
if
is it
mine is
now?
low as
Is it clearer?
well. Okay. Yeah, it's
Is it
better
clearer?
now. Mm-hmm.
Yeah.
Is it better now?
Yeah.
Yeah.
By far.
Okay, excellent. So thank you so much, guys, for taking the time to join this conversation. I know it's a public holiday, and you should be at home resting and having fun. But I think it's important that we have this chat real quick. So I'm just gonna dive right into it. Today's conversation is gonna border around alternative real estate assets across the continent, and what the industry can do to begin to institutionalize this asset, especially those with heavy potential. Um, so before we dive right into in the conversation proper, I'd just like to do a quick introduction for those of us joining that probably don't know our speakers. So I have on this call Tola Oyenepo, who heads research at DR Patungumi and Co. Is one of the frontier real estate services companies, with heavy presence across Nigeria. And then we have Dapo Chawa, who heads professional services at CW Real Estate, a luxury real estate services company. And so this conversation, like I mentioned, is gonna border around how the continent can begin to institutionalize alternative real estate assets across the continent, and then what that means in terms of what operators should be doing, what other players in the market should be doing, or what the signs um, you know look like for translating alternative assets into institutional grade investment asset class for investors. So I'll just do a quick intro to give some context before we dive right into the conversation. Over the past decade, I think over almost $2 billion dollars have been invested has been invested in traditional sectors in Africa, traditional real estate sectors in Africa. So whether it is through acquisitions, whether it's through disposals or new development, that much money has been deployed. If you look at asset classes that is deployed, so traditional sectors like retail, offices, and hospitality essentially have sort of like lead um, as investment destinations. So institutional capital, the bulk of it is going into retail asset class, people building high grade malls, grade A offices, um, high end hospitality um, projects across the continent. Other, I would say, very nascent asset class like industrial is beginning to gain traction. But if you look at the data across the continent, there's not been so much investment in alternative sectors like healthcare, student housing, young professional housing, and even which is quite interesting. And I know a bunch of factors are responsible for that, but which is essentially some of the things we are going to be unpacking in this conversation. But the real question that I continue to ask myself is the opportunities in these sectors are very clear, but it seems that there's something off with investors' appetite on the sector. It could be the level of maturity in the market. It could be um, the level of transparency in those segments. I don't know what that is, and but the biggest question I would like us to answer in this conversation is to understand what it would take in real life to really move these asset classes, the student accommodation asset class, the healthcare asset class, the data center asset class, to move them from these compelling narratives that we see into something that institutional investors can actually begin to put money in, and how it can drive growth, real estate sector growth over the next decade, right? So I'll just start off and dive right into the conversation. And Tola, I would like to start with you, to share some thoughts around, some of this data we've seen, some of these investments we've seen, the sectors that they've gone in, the traditional sectors. I want you to share some thoughts around what you think is really the reason why, there's been so much interest in these traditional sectors compared to the alternative sectors, where they seem to even be more, the fundamentals as they seem to be more to be clearer. For instance, student housing, there's a very huge demand there. We can talk about it much later. Healthcare, there's clear demand there. No one needs to be told, but we can talk about what the numbers look like later. Data centers, just across board. But they seem over the past decade that institutional interest has been concentrated on traditional sectors. From your perspective, what is the reason for that?
Okay. Can you hear me?
Yeah, we can hear you.
Yeah.
Okay. Thank you very much. Thank you for this platform. Just to share and learn. I think so. There are a lot of moving parts. I think that's one way to look at it. But if we're going to sum it, with one word, we'll probably be looking at market maturity. Um, and so what has happened is in the last decade, the early 2000s, right? So that's that decade into the second decade. There were a lot of interest in Nigeria, right, from international investors, from foreign players. And the reason wasn't far fetched at the time, and that was because of the stability in the market or in the economy. Because at the end of the day, we cannot discuss these things without really looking at the macros and how the macros are influencing investor confidence in the market. And I think so. If we're going to look at it from a historical perspective, we are saying that okay, what what was the state of Nigeria's economy, 2 decades ago?
Mhm.
What were the things that investors were looking at? Because those variables haven't changed in terms of what investors are looking at. The benchmarks are the same, the variables are the same. So if what they looked at 10 years ago or 2 decades ago, has changed now, then we should expect, you know, changes as well in their behavior and how they react to the market. So there were a lot of, stability in the market when Nigeria we just got independent. I mean, just democracy, not independence, democracy, right? And so there was that stability. We had the revenues and all of that. So we're able to attract these guys, so a lot of deals were already conceptualized. There were a lot of construction. So we began to see, I think it was retail that picked up first. And then we began to see activities in office and including hospitality, right? But what has also happened is that I think from 2015, that confidence began to dwindle. And just because most of these projects have been conceptualized already, they're already in the table, most are already at the construction stage, right? So it was a case of let's just finish this thing up. And of course, some of them had signed occupier deals, so they had like off takers, they had some had anchor tenants, and the likes, right? But 2015 happened, right? And these conversations couldn't really scale up,
Yeah,
right?
much.
But we didn't see the effect of that until 4 5 years after. And then what then happened was COVID kind of just exposed, the the complexities that surround Nigeria's markets. So it became more obvious, right? And then even if as an investor or as an operator, if you were not open to change, you had to be open to change when COVID happened, right? So there were a lot of restructuring, at that time, and because of the buzz around COVID and how it's become the new normal, and so some of those developments were able to get some traction, right, because of that buzz. But the question is, what then is happening now, right? And I would like to say that personally, I think we are back to that early 2000s where we saw some sort of stability in the market, and we have these guys coming back, right? But just like it took some time before we saw the effects, or it took some time before we saw a materialization of those conversations in the early 2000s, right? It's also going to take a bit of time. Yeah, but although things will move a bit faster because now there is technology, there is AI, so things are going to move a bit faster. It's not going to take that long a time, right? But the conversation has shifted. Number one, investors are coming back in. There are a lot of FDIs. We've not even our reserves. What we are seeing now, we've not had it. In decades, right? I mean, the amount that we're seeing now. So those variables are returning. So I'm saying that when investors, when they were discussing 20 years ago, and they were looking at certain variables that made them come into the market, those variables are still what they are looking at today. And we are saying that now there was some sort of improvement, right? And so we would see. I mean, I was looking at an IMF chart yesterday that was showing how investments are moving across the globe. So from various continents between 2024, I saw 2024 and then 2025. What I saw was that between 2024 and 2025, the investments have reduced, particularly in the US and even in Europe. So there's a lot of, and the question is, where are those investments going? And I saw the charts. You could see that Africa has gone up. You could see that South Asia, North Asia, those Central Asia, those guys have gone up. Why? Because number one, they have the young labor, they have the population, they have the skill, right? So investors are so it might take a bit of time, maybe 2 years, 3 years before we begin to see the realization of those conversations that are already happening now, right? But again, just like, and back to the point around market maturity, Nigeria had gotten to a point in the mid 2000s where we could now begin to attract larger sized assets. So maybe the grade A assets, the grade B assets, the large shopping malls and things like that. And it's, so Nigeria, we've had that season, right? And now investors are looking at what are the alternative assets, right? And so we are seeing a lot of alternative assets within the various subsectors that interest are now beginning to come into. But that's because it's Nigeria. I mean, the case is different in South Africa because it's a more mature market, right? And then we talk about Nigeria. At what stage are we in? The market maturity is what determines what investors will look at in the market and bring in their funds to invest in. But again, just like we have the story in South Africa, different from the story in Nigeria, it's also different in a country like Zimbabwe, right? I mean, Zimbabwe, I think I just saw recently, a deal just signed for a very large $100 million retail-sized mall, right? In Zimbabwe, Zimbabwe or Zambia, one of those countries, right? But it's a function of market maturity. So so it's a function of market maturity. How the market is moving, investors are looking at these things. So the transparency in the market, the kind of data that is available, that's why I said there's a lot of moving parts. So these things are being looked at from a macro perspective. They are looking at it from consumer behavior perspective. They're also looking at it, right? And how transparent is the market? The more transparent the market, the more attraction it can get. So I think so. Just to sum up my response, that I think it's almost like a no-brainer that alternative assets are being considered today. But the scale and the rate at which we'll begin to see those, we're already seeing some in the data center, in the data centers, in the data center market. What we are talking about in terms of data center, in terms of our capacity today, it wasn't the case 3 years or 4 years ago. And you can see
Yeah.
that in 4 years, it has really scaled. And so you can imagine what figures we'll be looking at in about another 2 years, another 3 years, or another 5 years.
Okay, thank you so much, Kola. Before I comment, I'd like you to share your perspective from your experience in the market, researching African markets. What do you think have been the key driver of investment in traditional sectors? Tola mentioned this growing interest in alternative, which is what this conversation is. But let's set the tone first. What drove investment in traditional sectors, office,
Yeah,
research,
I mean,
particular?
for the traditional sector angle, right? The first thing was, when you look at retail, office, the retail and office sector, by the time you look at what investors really look out for, so that's stuff like anchor tenants, dollar-dominated leases, comparable transaction evidence, right? That makes underwriting really, really straightforward. You get There was enough confidence in what the outcome would be at the end of the day. So when I say outcome, I'm referring to the return. So once you have that confidence, you have the conviction to invest as much as you have in order to make certain return on the investment, right? So that was what drove the investment in the traditional space. So that retail, office, hospitality, even residential, right? But now, we have a concentration, and we've gotten to a plus, a point where we have, due to oversupply in some of the market, especially the office market, we have what are called yield compression, right? So the returns that these developers are making, these investors are making, uh, have compressed over a period of time, over the last 2 decades, like Dollar said, 20,000 to the early 2000s, right? Yield has reduced, there's oversupply in some markets, and attitudes have changed, just like we've seen with the large retail malls in Nigeria and Kenya, right? We are going from having large over 10K square meter malls to everybody now adapting to building neighborhood, and that's what is really, really moving in the market. So now, when you look at those, you see that returns on investment have reduced, and now the numbers in the traditional sectors are less compelling than they used to be compared
Yeah.
to what we are now seeing in the alternative sector. So at the end of the day, it's all down to return on investment and how much the investors and the developers are going to look by the time to make this investment choices really reflected.
Yeah, thank you so much, Dapo. And just to sum it up, what I'm hearing from what both of you have said is standardization and general market maturity, heavily, which was heavily driven by what was also happening in the macro economy across the continent, really drove investment in these sectors. And this is what I could pick from it. Obviously, the real estate sector performance depends so much on how the macroeconomy is doing. And we've seen where macro is doing very well, real estate does much better, and vice versa. And so, Tola, what I could pick from what you said is the fundamentals, macro fundamentals, were very strong in the early 2000s. GDP, population, and all of those signals, they were very clear. And so that drove FDI, know, into different countries across the continent. Businesses were coming in, multinationals were coming in. Obviously, multinationals are coming in, and there's a lot of business travel. It's going to drive demand for hospitality. It's going to drive demand for office, because who's going to house these guys coming in? Solid anchors coming into the country, the likes of Facebook, the likes of Twitter coming into the continent rather. Um, That's going to drive hospitality, that's going to drive office demand. So back to what Dako said, that heavy anchor presence across the continent drove demand. And obviously, when there is very high demand signal, the capital will follow it, right? So there was capital following it in building offices, in building hotel, hospitality projects across the continent. And then on the other side, which is the retail side, um, population fundamentals and a growing middle to upper class across the continent also drove investment in retail. So when you have more people with more disposable money to spend in larger numbers across the continent, obviously there will be demand for, I would say, high-end shopping experiences, and so that is what sort of like influenced development a lot of the major malls that you have in across the continent. And so that is what I've picked from both of your conversation. And then that demand and early development presence, I would say, gave investors, even sort of like standardized the market and gave investors, and that go back to your point, gave investors critical metrics sort of to benchmark
The
again.
benchmark.
Yeah, and they were good, and so it drove a lot of investment. Also, more guys could compare transactions that has happened, development that happened, compare returns, because there were quite a handful of developments in these sectors across the continent. And that grew and grew and grew in terms of acquisitions and new development until the market matured, right? That go back to your point in terms of until the market is sort of like um oversupply for some markets like office, like that what you mentioned. And then Tola, back to you. There is still investment in the sector, or rather, in the continent. There's still investment. I think that IMF data chart we were looking at, I've seen it. I think I saw it a while ago, and that made me ask a lot of questions. So there is this capital leaving the broader West to look for emerging opportunities in Africa and Asia. How are we positioning, to really capitalize on this investment? Real estate sector is a major destination for FDI, and if traditional sectors are not as compelling as it used to be, how are we positioning alternative asset class that have that we are seeing some of these early signals, Tola, that you mentioned in the early 2000s. How are we positioning those asset classes with those signals for growth? So I'll just take a look at a few numbers again to help us set the tone um, for the deep dive we are going to go into now. Now, urbanization across the continent is growing significantly. I think the World Bank projects that by 2050, Africa will house 25% of the world population. In addition to that, Africa will be the largest continent, in the world. Now, that is a very solid population fundamental again that will drive a lot of demand. And just to top it up, there are projections that over 50% of that population will be very young. I mean, people from the ages of 16, I think, to like 35 or 40 year about. When you have that strong young population, it's pointing to quite a number of, I would say, potential problems that obviously can be translated to big opportunities. Now, on the other hand, tech adoption around the world is growing. And I was having a conversation with someone, I think, last week, and I was telling them that with the way AI is going, with the way advanced computing is going, I don't think there's any continent around the world that can essentially house, or rather, realistically house the data center demand that the world will need. And what I mean is, who has this kind of land, who has this kind of young population and labor force, who has this kind of, where does the unit economics make sense, where labor is cheap and all of that is cheap, to be able to power or rather house the data center demand that the world will need. And I keep thinking to myself, it only makes sense in Africa, right? It only makes sense in Africa. Now back to the population number. When you have that kind of population, I don't think Africa is ready from a healthcare standpoint to meet those needs. So there's gonna be heavy demand in all of this thing I'm saying. There's gonna be heavy demand in these emerging sectors like student housing, young professional housing, data center, healthcare, and also senior care. And now the question I have is, Dapo, back to you. When you look at these structural drivers, some of these things that Tola had already mentioned were good signals in the 2000s that we're also seeing as again in the early to mid 2020s. Um, what do you think in terms of emerging or rather alternative sectors that which alternative sectors do you think is most ready that can easily translate into institutional grade assets for the market in the next 5 years? I'm saying, obviously, from your submission earlier, you talked about the office and retail, particularly how those were like some of the early sectors to gain traction, right? What would that be for alternative real estate asset class um, over the next 5 years that can give investors easily bankable investment opportunity and easily compare that can become easily comparable um, over the next 5 years? So that's I would like to start with you, your perspective, and we can go to Toledo.
Okay, so when looking at the alternate real estate asset class, I think the first one that I would say is the most immediately bankable would likely be or would be data center, right? Because all around the world, with the gradual adoption of AI around the world, we need more GPUs, and we have already available off-takers. The rationale is very, very straightforward, right? There's an increased demand for AI. We need more data centers, and we are building more around the world. Even here in Lagos, we currently have about 20 facilities, yeah, over 20 facilities with over almost 80 megawatts in total. And in our pipeline, we have almost double that, about 150 megawatts in the pipeline, right? So you can see that there's already an heavy investment in the data center market when you look at it in and across the continent. Lagos isn't even the biggest one. We have larger data centers in Kenya. We have larger data centers, I think, down south also. So that's the number one that investors have identified due to when you look at future use of AI and artificial intelligence in human affairs. I think the next one would be student housing. Like you mentioned, Africa has a very, very young population. Nigeria has a very young population. Kenya has a young population. South Africa has a very young population. So the demand is immediate, right, and it's well documented. And if you look across the continent, we barely have institutional investment in student housing, except with what Acorn is doing in Kenya. But in Nigeria, I think as of 2021, less than 30% of Nigerian tertiary students had access to on-campus accommodation. So that
Mm-hmm.
means we have a gap, very large gap, waiting to be exploited, right? So, I mean, what we need now is a trustworthy operator and patient institutional capital in order for that to exist at scale in Nigeria. Especially when you look at what Acorn has been doing in Kenya, once we can replicate that particular model in Nigeria, I think that's something that a lot of developers, a lot of investors can really, really benefit from because the ROI, the investment returns are very, very interesting right now. Then I think the one I don't really, really have high hopes on from a personal perspective is senior care, right? Senior care. So currently, if you look at the how will I put it, the average mortality rate, let's see, the age, yeah, mortality rate is around, I think for Africa, for Nigeria, it's around 54 years old for a woman and 52 for men, right? So if you are making it past 54 as a Nigerian, you are already, statistically, you're already an old person, right? That means that we have less people who make it past 60, lesser people who make it past 70. So it just depends on the need, right? While there isn't any formal investment infrastructure yet, right? There are private developers that are building these facilities. Like I know Lakaway, for example, are
Mhm.
building something for people that are more advanced in the country. But I think for now, the demand market is very, very, very low, and uh, it's focused on a very niche market. So that's the upper middle class and maybe people that are in the diaspora looking to come back to Nigeria and spend less on senior care. But before we can say, okay, we need institutional capital to move into this particular property sector, or this particular alternative real estate sector, we have to
Mhm.
first improve the macros that will improve the quality of life, that will improve how long people live generally in the country. So yeah, that's the kind of breakdown that we take this before we begin to look at it. For just in a nutshell, data centers, look, they are the most immediate bankable ones we can recommend. The second one is the student housing. We have a very, very large demand in the country currently. A very large demand. I think we have over 2 million students in the country, and like I said, less than 30% have access to on-campus accommodation as of now. Then I think last would be the senior care accommodation because there isn't really a very large demand yet in that particular sector.
Thank you so much, Dapo. You made really, really interesting point. I'd like us to touch on again. But before we do that, so Tola, back to you. There are alternative sectors, there are even new emerging opportunities, emerging subsectors in the market. So we are talking healthcare in general, and then senior care in particular. We are talking data centers. We are talking student housing. We are talking young professional housing. We are talking all of these, logistics and industrial parks, as alternative sectors that institutional money can go into. What do you think, from your perspective, will be like the retail, the office, and the hospitality in the next 5 years from the alternative sector? What sectors do you think will drive the most, or rather, is most ripe for institutional capital?
Okay. Um, hmm. So so I'm trying to come from a certain perspective, and that's because, so I think, so yes, Nigeria is ripe for certain asset classes, alternative asset classes across the various subsectors. But I think one of the things that I think can, if it's in place or if we are seeing some traction in, can actually drive up activities in some of these alternative asset classes, and that is infrastructure. And I'm saying that now because infrastructure, as the conversation around infrastructure has gone beyond government, right? We are now beginning to see a lot of more institutional capital in infrastructure. And the reason is because infrastructure is like, it's like
The enabler.
uh, the enabler. Yes, it's like a foundation. So you have that in place. It's like plug. So real estate becomes like plug and play when you have that. So and I feel like, because again, so just to, and I'm going to think this to, the subsectors you mentioned, which is retail and the likes. Now, for instance, one of the major infrastructure projects, or one of the major infrastructure that I believe, if can, if we can see a lot of activities around it, it will really, it will really have an
Open up the
effect on these various alternative sectors, which is, aside from roads, so things like rail. And the reason why rail, I believe, is a major conversation is because when you have a rail line or a rail path, it's easy for you to, determine structures around it. So for instance, you have like a rail station, but it's not just a station for people to come in and buy tickets, right? You are looking at, what are the real estate activities that can be instituted around that station. So what kinds of retail options can we see? What kind of hospitality options can we see, right? Because again, when investors bring in this capital into this asset, which is infrastructure, they are looking at getting their money back, right? They are looking at return on investment, right? And that is where, aside from, because again, ticketing might not be sufficient enough to give, that return on investment. So, right, so real estate now becomes a supporting income stream, right? To to just, it becomes a supporting income stream to make the investment very, very attractive, right? So conversations around those kinds of an infrastructure like that, conversations around it are no longer, solely done by the government or even just institutional players. We are now seeing even real estate advisors, right, coming into the conversation, because just like you have, as I mentioned, a station, right, and you can have a number of them across a particular path, and each of them have supporting real estate uses. So in a case like that, you are no longer looking at larger sized developments, or you're now looking at, smaller sized retail offerings. You're looking at boutique hotels. You are looking at, something more, not grand in terms of size, but something very, very sophisticated and prime. Because again, multinationals are coming into a particular place. They're saying, okay, where can we have our employees? Our employees need to be, situated, at least very close to the office. There must be that agglomeration of economics, where we have just everything together. There is no, you are coming from a far distance to come to work. There is that concentration around a particular axis, which it just helps quality of living. So I feel like, when we talk about infrastructure, it's beyond the asset. We're talking about economic growth. The effects of infrastructure on the asset class is, we can't. It's not something we can discuss, as a whole, even on this call. It's very broad. So we're looking at economic growth. We're looking at, quality of living. We're looking at and predictability of income. I mean, it will surprise you that, maybe not surprise you, we are all professionals here, but just think about having a particular, and we see an example of it even in Ikobi around Falun, right, where we see a multi-level parking. So I'm just trying to give a picture that, just imagine having structures like that. Parking is a challenge in Lagos, right? So if you have just that kind of supporting infrastructure, for other real estate assets, just imagine the kind of income, that can come out of just that thought, which is, just having, just ticketing cars per hour, per day, and just imagine the number of cars that can, you're coming into a train station, you need to have a place to park, those kinds of revenue streams, are getting more intense, right? But I think the goal is, how can infrastructure support how can you support the growth of real estate as a whole? So whether we're talking about senior care, whether we're talking about even data centers, I mean, Lagos had to do a lot of work in infrastructure to get the data sector capacity to where it is today. And there's still
Yeah,
a lot more that still needs to be done. But you will
yeah,
agree with me that it was those infrastructure around the Lekki axis, linking Eco Hotel and Eco Atlantic, all those axes, those kinds of infrastructure. And they don't come at a conservative price. These are huge capital, right? So DFIs, even those kind of institutional capital needs to be more present in that conversation so that we can scale this thing up. I just feel like at the end of the day, the resilience of the real estate market over time is what determines how sustainable it will be. How can the real estate market, how can it absorb shocks? Now we're talking about the Iran war. Everybody's praying that it doesn't get to Africa, maybe Nigeria, but
but we're feeling the impact already.
I mean, yes, from that angle. But now
Yeah, for
looking
us to.
at, yes, but I mean, that's even maybe from, how will I put it now? Maybe from a consumer behavior perspective. But if we are looking at things like, attracting, because who are the occupiers of, yes, we are seeing indigenous firms with robust balance sheets today, thankfully, right? But the capital that we need to
We
attract
also.
those kind of capital, yes, we need to have a more resilient, and the market has to be more mature. That's what differentiates Nigeria from like South Africa, even though we're all on the same continent, is the maturity of the market and how resilient the market has been over time.
Thank you so much, Tola. I think you raised a very important point. And that is a part of this conversation that I think is extremely important, because beyond this alternative asset class, real estate, infrastructure is going to emerge as a very bankable um, asset class that would drive a lot of demand for real estate and grow the market. Um, Real estate follows infrastructure, development follows infrastructure. It doesn't go before infrastructure. The right way is for infrastructure to go, and everything else follows. And I think we're already seeing a lot of activity in that space. Public-private coalitions, to raise capital from the market, invest in real estate and invest in infrastructure, and a lot of that. And I think we will see a lot more of that. And we'll come back to this conversation because there's a lot to unpack around how the private sector can participate with the public sector in putting together capital from the market to build what that model would look like, how return is going to be is going to be patterned, how risk is going to be priced, and a lot of stuff. There's a lot to unpack around that, right? And I think you're right. It will be the biggest um it will be the biggest sector over the next decade. And the reason is just that it is that critical foundation. You can't build anything else without infrastructure, right? So it is that critical foundation. And we're going to see a lot more interest in that. But before we get into that, I just want to get back to you very quickly. You made a very important point around the data sector, data center sector, and how it's going to drive a lot of private capital, particularly institutional capital, in the market. But I want us to look at it from a different angle. Historically, when I say historically, I mean for emerging markets, what's really always driving the market is the presence of anchor. So we are seeing anchor tenant led growth. We saw that happen in the office sector. We saw that happen in the retail sector, um, and even in the data center sector. We are seeing that even happen more clear. And this is what I mean. When major anchors are ready to get into a market, it sort of pushes developers and institutional investors to be able to build for these anchors. So we have anchor office occupiers and anchor retail occupiers coming into the market that drove the likes of Attack, the likes of Actis, the likes of all of these guys to build prime retail and office assets across the continent. But and that has continued. It has always been the anchor tenants coming in, the big guys coming in, that bankable demand that is driving that. But what we're even seeing in the data center space is I like to think more of hyperscale interest from the likes of Microsoft, major anchors, the likes of Google, major anchors, the likes of Amazon, major anchors, you know, and their presence or their interest in the continent is beginning to sort of translate to investment, particularly in places in South Africa, Nigeria, Kenya, and investment in data center. My question is, how do you see the market playing out over the next decade? Do you think that data centers, you know, do you think that this demand is going to drive institutional appetite for African data center beyond just these major guys coming to build for themselves? I mean, are you going to see um, institutional capital and developers building in that space to serve the market, or is it going to be sort of a tenant-led um, market from your perspective?
Okay, I think first we have to look at the data, right? So if you look at what we currently have, the total stock of data centers in Nigeria, most of them are currently operator occupied, owner occupied, right?
Mm-hmm.
Most of these developments are operator led. So your Google, your Apple, your Microsoft, your NXtra is by Excel, Equinix. Those are all operators, right? So it's for them, it's just part of infrastructure. It's infrastructure that they need to run their own operations. But now, um, investors are beginning to see data centers as an income generating asset of theirs. So if as an investor, I can build a data center and then rent it out to people who need them, so the Airtel, the Google, the Microsoft, and get returns on it. Of course, I'll go for it. And by the time you look at what the early movers are making on average, and that's on a cumulative annual revenue, right? It's it's in double figures, right? That's really attractive. But by the time you look at the other asset classes, very traditional asset classes like residential, for example, in Nigeria, the yield is around 4 to 7%, right? But when you look at data center, it's double figures. So it's just the numbers just make sense, right? So now instead
Mm-hmm.
of everything being led by operators, we have private investors, right, whether local or international, now beginning to build these as a service to operators in the market. Now, what Africa has is that we have a big, uh, a big advantage with the subsea cable infrastructure, right? Google's Equino and Meta's to Africa cable, right? So it makes sense for these investors to plug in and build this infrastructure for those who need them. Right now, and the thing is that right now, most of the operators, by the time you look at the market here, they are still leading the market. But like I said, we have almost double of the current stock coming on board in the next 5 to 10 years, right? So that gap is closing. And because it's still an early investment class, the returns are still fantastic. So that's the current advantage we are seeing. So there's still a very large appetite because most of it is if operators.
Tola, can you still hear Dako, or is it just from
No,
me?
no, I can't. I
Okay.
think it's from his end.
Yeah, we're losing him forever.
Hello?
I think it's back. Okay.
Dako,
Hello?
we lost you. We lost you for a bit.
Oh, my bad. Sorry about that. What was the last thing you had? Let me just
So you were talking about the pipeline is double the existing stock, and
Yes.
then
So, I mean, the current stock is still operator led, right? But we have a pipeline that's almost double that. That's going to come on board over the next 5 years. Right? And most of that is for institutional investment. And that would only increase as time goes on because at this moment, the returns are very, very, very attractive. So,
attractive.
yeah,
Yeah,
very
I
much.
agree with you. And I have some thoughts around that. You will agree with me that while a lot of the multinationals that came into the country, not a lot, a few of them built their offices. Um, in South Africa, the big banks, came in from the US, from the UK. They built their offices. Um, the telcos in the rest of the market were renting, right? So the Metas, the Facebooks, the Twitters of this world, all of these guys they were renting. So that strong demand created a heavy incentive for private operator developers to build, right? But because data center is very niche in the sense that their requirements are very very unique to a lot of they are their baseline requirements across the board that you can benchmark against. But when it comes to different companies and different telcos, um, they are an IT firm. Their requirements are very niche, and I think it's also part of the reason why the market is still operator led at this point. And my question is, if the big guys are building their own data centers, would there still be enough demand to incentivize private capital, private operator presence in the space? Or what are your thoughts around that? Because it's a very big concern that I'm having that we might not see hyper secondary market growth or retail market growth in not secondary retail market growth in the data center space. A lot of these guys will just build their data centers. Security, um, very specific requirements from them is informing this as well. But just beyond this, do you think there will be a retail market for things like data center over the next 5 years for the continent?
Well, I think it depends, right? And first things first, we have to answer what's driving the current uh, development of data centers around the world. And you'd agree with me that it has been the adoption of artificial intelligence. Right?
Mm-hmm.
Now, as we progress down the line and the need for usage of artificial intelligence increases, likely, which is more likely than we are going to need more data centers, not just in Africa, but around the world. Right? Now, by the time we adopt more AI, that means more people are using AI to build businesses, to try and reduce the cost of living, to make things more seamless and stuff like that. So, as with other traditional markets, they're going to see grades. So, they're going to be the grades that are going to cater to the likes of Microsoft, Equinox, Google, and whatever. They are going to
Mm-hmm.
have the small scale, maybe lower grade data centers that can cater to Mr. Obasanjo go down the road that just wants to optimate an issue, you understand, without being there. So it's I mean, that's what I feel is going to end up being like. But at the end of the day, uh, if you extrapolate what uh, humans and AI are going to achieve in the near future, right? It's going to be like how the internet came and changed everything. There's barely anything we can do without the internet now, right? So that's how it's going to be with AI. Now, I don't know how it's going to turn out, but I know that down the line, AI will not even be like that AI, but just be a part of the day. And for us to be able to do that, we're going to need more and more data center data for not just the big guys, but also the everyday user. Yeah.
Okay, thank you, Dapo, and that makes a lot of sense. So we are going to move the conversation a bit just shifts it further down, the other asset classes. So across the continent, I think I don't think there's any country, or rather, the average student housing, I mean, purpose built, school provided accommodation across the continent, to student population ratio is less than 25%. That means, on the average, less than 25%, there's less than 25% purpose built student hostel that is provided by institutions themselves, for students. And like you said, we have a very large young student population. University enrollment is expanding across the continent, and outside of, let's say, South Africa and Kenya, that number is even much lower. Um, and honestly, off-taker risk, in my opinion, is relatively low compared to even commercial real estate, because students are enrolling in schools, every year, every semester. There is session going on, so there is always that population. There's always that demand, there. And my question is, and Dakwa, I would like to start with you. What will it take to really attract the scale of private capital needed to fund that market? I know it draws so much parallel with things like affordable housing that's very difficult, for the continent, to solve. But I believe student housing sort of even provides a more compelling, um, it's more compelling compared to things like affordable housing. And honestly, if you look at markets like Kenya, the Acorn student housing, company in Kenya that you mentioned, they seem to be figuring it out. So my question is, what does what would it take really to build a very credible institutional, institution backed student housing market, for the broader Africa, and you can draw a lot of lessons from, what you are seeing in Kenya, for example.
Yeah, I think for student housing, Econ still remains the standard, right? Econ remains the standard. And by the time you look at what they're doing and try to figure it out, you realize what they're doing is they're focusing on long leases, purpose built, ESG-linked student housing development. Now, very important note there is ESG-linked, because by the time you build a property that is ESG-linked now, it's easier for you to raise money. So for Acorn, most of their hostels have been ESG linked, and I think over the last 5, 10 years, we've been able to raise almost 220 something million dollars, $221 million, right, from PFI. So basically, we have the track record. They meet PFI criteria. They have ESG linked financing framework, and they use the long list model. This is how they're able to make their money back, how they're able to finance this development. Anyways, this what works in Kenya might not necessarily work in Nigeria, might not necessarily work in Ghana, might not necessarily work in Algeria or South Africa. And why? Why is that? Uh, you have to look at it from a capital and return perspective, which every investor is going to, right? So you ask yourself, ideally, if I build this student housing, let's say in Yaba, right? At what price point do I have to rent out in order to make my money back? Now, for most investors, by the time they're building developments like this, they're looking at a 10, 15-year exit, right? Now, what's the skill needed for you to break even and make some return on that investment? Because when you are leasing, you have to look at a very long horizon, right? Then, how can I ensure that my student housing that I'm building, the rent there are not higher than the rent I would see in a normal uh, accommodation in that area? For example, if I'm building a student housing and I say, okay, want to make a break even and make attractive returns in 15 years is 2.5 million a year, right? But in that same area, the rent there are going for a million naira. I'm kidding myself. And at that same price point of 2.5 million, I still have to, I still have to extend, I still have to build that skill. So I'm not building 50 bed, I'm not building 20 bed. I have to build above 100 for me to make some money. So the economics have to make sense too, and that's the current issue. I mean, developers in this climate in Nigeria are having the space to build that skill. One, then finding the price point where it should not even look, it's not what you are bringing to the market, even though it might be of better quality, it won't be way, way, way excessively above what the market average is for similar development like that. So that's been the major quagmire when it comes to building stuff like that. But if we have patient capital, patient investors who don't mind playing the long game, it can work out in the long game. And of course, it's going to need some government support because land, I think one of the biggest barriers to investment in the housing market is the cost of land. Acquisition of land is so expensive. It's hard to justify lower pricing for that market. I remember your target market is students, right? The target market is students and young professionals who haven't reached the peak of their financial earnings. So it's a very delicate balance between spending and getting your return on the investment.
Okay, thank you, Dapo. And I think I've had conversation with quite a number of developers, and I think you raised a very critical point that I've seen quite a number of them mention. Their limitations. There's just a return versus cost mismatch in that market. You are building for a very price sensitive market. Um, you know, you are building for a very, I would say, long term market, and a lot of the capital you find across most of the regions in Africa is not as patient, is not as forgiving, if I would use the word, and then just cost of land and cost of building and cost of running these facilities are a lot more expensive, despite the fact that the demand fundamentals are very high. I think yeah, if government can come in a way to provide give better access to developers who will be interested to operate, access to land, better funding structures and better partnerships. I think that's something that can potentially work. So thank you so much, Dapo. So Tola, I would like you to touch on the opportunities you are seeing in healthcare and senior care. And I would like to just paint a picture to give us a sense of what this is about. I know, Dapo, you mentioned the life expectancy rate for Nigeria and other African countries, but this is the picture I have in mind. There's been intensified migration of very young people from African countries to the West over the past decade. And so we have a lot of people in their 60s, in their 70s, and all their children are abroad. I know, and you and I know that historically, senior care in Africa, especially in a region like Nigeria, is largely family driven. So people taking care of their parents, you have married couples with their parents living with them, young couples with their parents living with them. So it's part of our culture, it's part of who we are, how we operate as a people. But over the past decade, you have seen a lot of young people leave to the West, to the US, UK, Europe, scattered around the world. And their parents are in Nigeria. They're in their late 50s, they're in their 60s, they're in their 70s. And that market is growing, right? A lot of them don't want to go stay with their children abroad. A lot of them are still back at home. And I'm saying beyond the traditional healthcare space that is heavily underinvested, there is this growth market of people in their 50s, their 60s, their 70s who are back here in Nigeria, and there are no purpose-built facilities tailored to meet their needs. I think they are just a step away. Part of it, like where Gulf and country estates that were mentioned. What are the opportunities that you are seeing in this market, and why are developers and private capital at large not looking at from your perspective, Tola?
Okay. I mean, I think the reason is very simple. The return, and just like that was already outlined, there is that obvious mismatch, right? So you bring in capital, it's obvious, except you are doing charity. They are not looking at it, and that's why there needs to be a strong, emphasis on patient capital. We can, to be honest, and this is how even the developed economies have grown, and that's how they are being. Not only that they have grown, but that's even how they are being sustained.
Yeah,
It's
patient
it's with,
capital.
it's with patient capital, right? But no doubt there are a lot of opportunities. Healthcare, senior care. In fact, this senior care thing, I'm having a conversation with one of my colleagues, who is really, really big on it, right? But capital, these are capitalist intensive stuff, right? And as an investor, you are here to make money, right? No matter how caring you are, you want to make money. So that's the reason why that patient capital, that institutional capital has to come in, right? Um, for healthcare, I think one of the things that's because again, as countries, as some of these developed countries continue to make migration or travel a bit more difficult, what that means is that it's going to trigger a lot of interest. Um, so people or particularly local capital that are not looking at that direction. So let's say like a REITs, right? A REITs or the pension fund that are not looking in that direction, who are still doing the old traditional real estate, right? Again, when you run the numbers and you can tell that it's long term, you just have to know that it's long term, right?
Yeah,
And you have strong partners because again some of these things are more operational, so you need people that have the skill. So for instance, an institutional capital wants to go into healthcare. Institutional capital is not thinking of operations, right? they're
operation.
thinking of they're thinking of investment, but that operational angle has to be solid as well. So the
Yeah,
partnership, the structuring around the partnership, who are the kinds of operators that we want, who are the kinds of partners that we want. And because it's a bit more specialized, so we are looking at diagnostic centers, we are looking at cancer
treatments. Yeah, treatment.
centers, medical labs that are more
Special.
specialized, and it requires a lot of skill, to kind of handle them. So that's, I think it's a mix of both. That has to be it has to be shown that we have that expertise. We have people who can do that, right? I'm sure there are people who are looking at coming into Nigeria to do that, right? But again, we are saying that okay, the ones that we have even here, right? Who are the operators that we have that are solid, that can partner to that level with institutional capital. So that's, I believe we'll begin to see a lot more in that regard. I mean, we've seen a lot of you know um, 250, 350, 400 bed hospitals coming up, thankfully, right? But we also need those specialized centers. That's one. For the senior care, I think, yeah, that I think it's a challenge I think it's a challenge, and to be honest, I'm not sure we are ready for that challenge, and I'm not sure I'm not sure we even know the extent to which that challenge would plague the country. But it's a major challenge. I know. I think and that's why it still boils down to patient capital, because it's not really just about passion. You can have the passion for it, so you want to have something for the retirement, those who are retired or the aged, but it goes beyond passion, right? You have to think long
Yeah.
term. You have to
Yeah.
you have to think long term, and just like Taco mentioned, there are there are key variables that kind of attract institutional capital. So one of it is the ESG, right? So ESG is almost becoming non-negotiable, right? Particularly in some of these alternative asset classes. So you have to have those considerations around ESG, particularly if you want to get the funding into, if you want to get the funding into your idea. So all of that is happening. I think I also want to talk about affordable housing, and again, it's patient capital, because if you look at just the cost of buying the land alone, and not just buying the land, you are also doing the titling, all of that, your profit is gone, right? So developers are not enthused, right? And that's why in developed countries, they have a separate structure for social housing.
Yeah.
Social I know we claim to have something like that in Nigeria as well, but it's not sufficient. And it's not sufficient because the reasons are clear. The macros are something else, right? So, I mean, one of the reasons why this MREIF thing is even gaining some traction and is a bit more, is doing a bit better than some of the previous schemes, is because of the government-backed investments that came into it at almost no interest rates. That's the reason why it's happening. So we need those kinds of conversations around these other sectors, because if you think about affordable housing, just think about essential workers. There are essential workers that just have to live in the city. They can't live outside the city. They are essential workers. They have to live close. They have to live in the city. Policemen have to live in the city. Doctors, nurses, teachers, all these people, they have to live in the city. So the opportunity is there. And I think I also wanted to say something about the student housing. I think, again, maybe, I don't know, but yeah, maybe the nomenclature, again, is also something we need to look at, because when we say student housing, it just gives the impression that it's students. But the truth is that some of these student housing schemes, some of these ideas around student housing, the kinds of design and the kind of quality that is being put into some of these projects are things that can even attract young professionals. And I'm saying that these young professionals, particularly the essential workers, the essential guys that just have to live in the city, they are not. It's not about trying to live a luxurious life. It's just really you are an essential worker. You need to live in the city. You need to live close to your work. You need to be able to respond quickly. Firefighters, those kinds of people. So I think we need some sort of reorientation, across the value chain. But it's not a solution that a developer can handle, because the developer doesn't have the capital. One.
Yeah.
It's also not a situation that just the institutional capital or the institutional guys can handle, because yes, they have the capital, but they don't have the skill, they don't have the expertise. So we need to have a more robust, like a robust roundtable. All the stakeholders have to be involved, and we really need to. Number one, real estate has to become a core asset. In terms of capital allocation, real estate has to become a core asset. It has to be something that the government is thinking about when they sleep, when they wake up. They are thinking real estate. It has to get to that level where we are thinking that real estate has become a core asset. How can we? There are different models. The PPPs as is one model that a lot of is widely recognized in Nigeria, but it's not. PPP is not the only model. There are all kinds. There are different models. One of which is which I referred to regarding MREIF. These models are there, and there are things that we can actually sit down and look at and say, how can we make a certain sector, how can we drive traction within a certain sector, what kinds of assets can we begin to look at. Yes, the return might not be short term, but it's patient capital, and that's why it's there, and it's sustainable. It's ESG linked, and the cash flow is looking attractive, right? So
Yeah.
I think those are some of the things that we need to really, really look at.
Thank you, Tola. And you made very important point that is making me think we should zoom out a bit from this deep dive conversation to even talk about the capital sources and how we can mobilize more local capital to fund real estate and infrastructure across the continent. And the truth is, capital is central to real estate. Capital determines what gets built. Capital determines what considerations, um, that developers or even operators have in mind. Capital determines a lot of stuff. And you made a very great point around, how, obviously the MoFi project, like the MREIF project in Nigeria, for instance, has made some progress or good progress, largely because of the government backing. Because of that capital source, it's been able to mobilize more local participation. It's been able to streamline the process. It's been and all of it's been able to that backing has been able to sort of make it easier for the program to run quite quite all right. And I want us to just zoom out a bit to talk about capital sources and how we can begin to mobilize more local capitals to fund our real estate sector. And when I mentioned in the intro that over 2 billion has been deployed in the past less than 10 decades, whether through acquisition, development, whatever it is, across the continent. If you look at the capital sources, you are seeing more DFIs, you are seeing more Pan-African private equity companies, you are seeing more, all of these guys deploying capital. But the bigger question is, how about the domestic institutional guys? The pension market in Nigeria is so huge, in South Africa is so big. Across the continent, there is a very deep pocket pension market in Africa, but this money remain largely underallocated to real estate. And if you think about it just generally, they have no incentive to to put their money in real estate because they can go and buy government bonds that give them double digit return. In Nigeria, for instance, you can go buy a government bond, it gives you double digit return. So if I'm a first bank pension, for example, why should I take my money and invest in real estate? Why where I'm gonna get 4 to 7% return if I invest in a REIT, for example, or invest in any other asset class, right? So why should I do that? So there is no incentive. They are not in infrastructure investments that has multiplier effect on on the economy. So there's no incentive now, and that's for domestic institutional capital. There's also not enough government-backed capital entry points that can be leveraged to mobilize local um, funds in every economy to invest in real estate or invest in infrastructure projects. MoFi is one of it, and I think the MREIF slash MoFi project actually has given us a blueprint on what can be done if government just cares about the people enough to put together schemes that address these real needs and mobilize capital from the market. Um, and honestly, just to wrap up this comment, the DFIs and the DFIs majorly are good, but we can't depend on external capital to grow our economy. We need to mobilize, local capital. There need to be more private, Pan-African private equity, interest in infrastructure, interest in real estate. There needs to be more domestic institutional capital interest. There needs to be more government backed guys like the MoFis, the pension funds, the active. We need to have more attacks, more actives of this world, more companies local, more capital local, more funds local, more government, you know, backed products local that is targeted at real estate and infrastructure. And my question is, what can we be doing honestly to mobilize more local capital in the market? It's not that there's no money in the market. There's money in the market, but it is very informal. It's not being structured in a way. It's not being structured or put together in a way that you know can form big projects. And why do I know that there is capital in the market? What do they call this thing? When you hear of this MMM, what's the name of this
Stevex.
last one I just have? What's the name
Stevex.
again? CBEX, exactly. So you are hearing trillions of naira. You are hearing money that can build. Honestly, so this money exists. So this money, people don't just have the, um, I would say, the channels to deploy it. And so when these schemes come, and people get bonds, and you see the amount of money that these schemes were able to put together from the economy, it sends a message, right? And my question is, how can we mobilize at scale locally to fund our growth as a continent and not depend on the DFIs? Just final thoughts as we wrap up, because we are like way past the time scheduled for this conversation. So Tola, let me start with you and I'll wrap up with that one.
Okay, I mean, to be honest, what comes to mind is the discipline. Is the discipline around um, is the discipline around it. I think so. Institutional discipline, really, because number one, it's something that you have to get the buy-in. So yes, the government has to trigger the conversation, but there are a lot of stakeholders. So there is the government, policymakers, there are financial institutions, there are, civil associations, all of these guys, have a skin in the game. They have a role to play in all of this. Again, we've seen an example with the new tax act, that the government has just implemented. And the whole point is, how can we grow the revenue base of government, right? But it's not just really about growing the revenue base of the government. It's also about deploying this revenue into what really matters, right? So I think the discipline around that, because again, you want to earn the trust of people, right? Um, in some developed nations, right? You know that you can you I think in the UK, yes, you probably have to buy your tickets to get into the train, to use the train, right? But in some other climes, you have your ticket, but you don't need to show it. I mean, so I'm saying you don't need to show it to enter the train. There's just that trust in the atmosphere. Everybody just believes that people are abiding by the laws or by the rules, but they're able to get the economy to that point because of certain things that they've been able to put in place. So I'm saying that yes, we pull the revenue, but what are we? I mean, there's a lot of money now that is within the pockets of the state governors. There's a lot of money now within not just even state, but even within the local governments, right? What are these funds? How are these funds being deployed? What are they? 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 What ideas are being implemented with these funds? Right. So I think if the government wants to get funds from people, they can get it, right? But again, there's also so I think maybe we can look at maybe the government bonds now, which treasury bills, which are getting a lot of the attractive yields, and that's where a lot of money, a lot of funds are going into that pocket, right? But
Yeah.
now the government is thinking that if if we make this particular thing unattractive, right, we are going to lose the money that we are getting through this stream. But I think there should be a balance. There's a balance. That's why I said, okay, we are saying that, okay, we are seeing the new tax act coming into play, right? There are so many other ways by which we can pool, these funds. We can't afford them to just be scattered in people's pocket. They have to be pooled, But yes, they are pooled. The question now is, how are they being deployed? Because that's really what people want to see. So people are saying that, oh, subsidy has gone. But the question is, what is the money being used for? How is the money being deployed? How are the funds being deployed? Right? So the buy-in, really, the government has to get the buy-in of the people. The financial institutions have to also be they also have to be in the conversation.
Yeah.
Associations have to also be, in the loop. Everybody has to kind of have, something. So everybody has to have something for us to get that participation that we really need.
Yeah.
If we don't do that, I mean, even with the whole structure, people are still trying to evade, not an talk of the structure being non-existent. So it just makes the economy a bit haphazard. But the structure, the thinking is, okay, getting the buy-in of people, getting ideas from the financial sector, getting the ideas from the civil associations, getting the ideas from policymakers, individuals, and just working together as a team to come up with, a particular idea that can work. I believe that's what happened with the tax act, right? And I think that can be implemented across, even other options as well.
Thank you, Tola. I think the most important thing I heard from you is discipline, which obviously I believe is super, super critical in how capital is mobilized, and not just mobilized, intentionally deployed and monitored in growing, the market. Dapo, your perspective, just final thoughts, as we wrap up on how we can mobilize local capital, to grow real estate and infrastructure space, across the continent.
I think the first thing has to be some form of transparency, right? The market needs to be transparent. We need to know what's renting for what, what's selling for what. Two, we need proper documentation for land and title. So currently, if you look across Lagos, less than 10%, I think it's less than 10% or less than 30% of the land parcels carry formal title documentation. So that's your C of O, right? So, and without this, without like having the right title, it's a risk for institutional investors, right? Nobody wants to invest, and tomorrow the government comes and say, you don't have the right papers for this place. Time to wrap it up. You understand? Same thing that happened to some of the guys who did stuff on that Costa Rica, right? So we need to be able to speed up that process in order for us to have assets that can be cleanly underwritten or invested in, to be honest. Then another thing is we need to also, so first I said transparency. Second thing I said is line title. And I think the third thing is we need to try and, I mean, that's for people that are the analysts, the people bringing out the data. We need to be able to bring out the opportunities to and not just identify the problem. For some of these domestic capital investors, they don't know the opportunities
The
that exist,
opportunities, yeah.
right? They don't know the opportunities that are beyond maybe the traditional market. They don't know the opportunities that are exist. So much more exposure, much more education needs to go into that, and begin to reap the returns as time goes on.
Okay, thank you so much, Dapo. And just as we wrap up, what I'm hearing is, discipline Yeah, and that discipline obviously requires a lot of transparency, in terms of, how what is going on in the market even, right? Because you really can't improve what you've not measured. If you don't know what's going on, if you don't know where capital is being deployed, what return profile is, what is selling, what's not selling, all of those very basic things, if you don't know, if there's no transparency with how land can be acquired and good titles can be secured, there's really no way we can grow. And to that last point, operators in the market, we need to do better with like putting out information, in helping participants in the market understand what really is going on. And that's sort of like the kind of work that we do. We put together conversations like this. We do put together market reports. We do research on the market to help anybody who is interacting with the space to understand what's going on and see where the opportunities are and where they can deploy money. So thank you so much, guys, for taking the time. Again, today is a
Thank
public
you.
day. You should be enjoying yourselves at home and with your families, but you made the time to join this conversation. Thank you so much. It's been quite insightful. We are 10 minutes, or rather 30 minutes. We've gone 30 minutes beyond the slated time, and that goes to say, I mean, it's been a very really interesting conversations, and I hope you enjoy the rest of your holiday. Thank you so much for joining, and those joining us online, thank you so much for joining, and to have the
Thank you very
best
much, Matt.
ahead.
Thank
Yeah.
you, Martin. Thank you for having us.
Thank you.
Thank
Thank you
you.
for having us.
All right, guys. Bye.
All right, bye.
Later. How do I leave?